Hi there, my name is Michael EJ, and I am here to present to you a different way to look at the stock market and equity valuations in general. What I'll be presenting is called the PVGO Thought Process for equity valuation. This is part one of a two-part series in which I will go through how expectations investing is the best way to look at the stock market. It's a different view, and it's actually a view that I believe most successful investors look at the stock market. I will begin by talking about John Maynard Keynes, and he is a famous economist that a lot of our politicians still believe in and follow his policies. And he had a belief. His belief was say that you're a judge at a beauty pageant. Essentially, what you're doing is you're not judging beauty off of what you think. You're judging who's the best and who's the most beautiful based off of what the other judges think. Who has the highest conviction? Whoever has the highest conviction, if your conviction is not as high, you might follow the other person. This is essentially how he thinks of the stock market. He thinks that you're pricing companies based not on what you think could happen, but what others are thinking, or more specifically, what others are expecting. This led me to look deeper into what exactly drives valuation in the stock market. There's two parts. You have the fundamentals, which you can consider as the statistic of the economic benefit, which is most of the time a lot of investors like to use earnings per share. You can also look at free cash flow, EBITDA, operating income, even just revenues. And the second part of that is growth expectations and the perceived risk associated with it. And you can think of that as the multiple. You can look at the company or industry outlook. If you expect the company to grow faster than the industry or slower than the industry, and market sentiment. Sometimes the market gets emotional, and sometimes those multiples don't necessarily reflect what the fundamentals are saying. With this in mind, I started looking to the most popular anomaly out there in the stock market and in the investment profession, and that's the value anomaly, value investing. And what I've concluded is that the value anomaly is really low expectations investing. And that's something I believe Ben Graham and Warren Buffett follows. And let me explain why. Think about why a company will have a low valuation. Really stems from two different scenarios. Either one, they have low relative growth, so a company with an average risk profile has little, no, or even negative growth expectations relative to peers or historical performance. The company's not expected to really grow, expected to be stagnant, might even expect to decline. Or something that Stephen Penman, a professor at the at Columbia University, pointed out, it could be high relative risk. A company with a higher risk profile with risky growth expectations relative to peers or historical performance. A company can just be riskier. You can just be paying for riskier growth. The company might be in retail, or it's a cyclical company. You're paying for that. And that's why the valuation is lower. It's not as guaranteed. And if you take this kind of relative growth, relative risk, expectations thought process to other anomalies, you might be able to explain them. For example, let's take size and illiquidity. On a relative level, small caps have higher risk. But let's not forget, they also have higher growth expectations. For some of these small caps, they're much higher. And it's possible they can actually meet those expectations. And more importantly, it can happen on an absolute basis. It's much easier for a company to grow from 100 million to 1 billion versus growing from 1 billion to 10 billion or 10 billion to 100 billion in either revenues, assets, market cap. Let's take the quality or profitability anomaly, in which higher quality, more profitable companies should trade at a higher multiple. And why should they trade at a higher multiple? Because they have the lowest relative risk. If a company has high returns on capital, high margins, little to no debt, management is friendly with dividends and stock buybacks, they should be trading at a higher multiple. And although I can't necessarily explain momentum in itself, I gotta kind of explain momentum reversal in terms of expectations. If a company over the short term just keeps rising higher and higher, more likely it's a growth stock. You might just buy the company just because of momentum. It's going up. It gets to a point where expectations are too high, the company can't meet it, and the company comes crashing down. Expectations got too high, and the company just can't meet those expectations, either in earnings per share growth, revenue growth, any type of expectation. And to show a example, or two examples of this, I'll look at two scenarios. One is Foot Locker, ticker FL, versus Finish Line, ticker FINL. Now, if you take a look at their market caps, you'll see that Finish Line is 9 times the size. Not only 9 times the size, they're probably 5 to 6 times the size in actual stores. Both of these companies are shoe retailers. They normally operate in malls. Foot Locker has many more outlets, different store concepts versus Finish Line. You take a look at the operating margin and free cash flow margin and return on assets, you'll see that Foot Locker is much higher. And another way it shows on the valuation is through price to sales. Price to sales matches up more with margins versus growth. So this is why Foot Locker's price to sales is twice as high, if not more. But if you look at the forward PEs, you'll see that Finish Line is actually higher. And that's mainly because of what's expected going forward in terms of not just growth, but the risk perceived with it. Both are expected to grow over the next couple of years at a decent clip, but the Finish Line is expected to grow at about 15% versus Foot Locker at only 9%. And that's kind of a huge difference if you think about it. It's almost twice the growth expected. But the PE is only slightly higher because it is safer looking at Foot Locker. It's a safer company. Another scenario I will present to you is VeriSign versus the entire S&P 500. VeriSign is the company that sparked this thought process, and they have such a high price to sales. I mean, when I first looked at the company a year ago, it was at 8, and to me that was almost an instant no-no if you follow traditional screening. And I look deeper and I can kind of see why it's higher. I mean, if you look at net profit margins, it's pretty high relative to the S&P 500. And if you also look at free cash flow margin, a very important margin, that's the conversion rate. Every dollar turns into 56 cents of free cash flow. That is pretty high. Remember, VeriSign essentially owns all of the .com domain names in the world. That's 40% of the internet. That's a pretty high clip. This is one, even though its market cap's only around 8 billion. To me, it's one of the safest companies to invest in the entire stock market. If you look at forward multiples, you'll see that S&P is still lower, although the growth is higher. The growth is not that much higher, 8% versus 11%. But what you also see is the safety in numbers, much higher net margin and higher free cash flow. It's actually some growth in sales, and even the past looks a little bit better. So, after these observations, I truly believe that the value versus growth debate isn't necessarily needed. It's more of an understanding of market expectations. By trying to understand potential returns the market expects from a stock for a given time horizon, an investor can decide if the market's expectations are either too high, too low, or just right. From there, an investor can make a recommendation as to if a stock is truly under, over, or fairly valued. So how can we understand the market's expectations? Believe this can be done utilizing the present value of growth opportunities, or PVGO Thought Process, in which you look at the value of a firm under a no growth scenario, plus looking at how growth expectations are baked into the price. This is a very well-known formula, actually, in the finance world, and it's taught in colleges to finance students. But I do feel like it's an underutilized formula, and believe that there are true benefits and insight coming from this formula. For a deeper perspective, this PVGO formula is based off of the Gordon growth model, and this train of thought can help an investor understand the market's expected returns for a given stock and weigh it against the risk. The goal of this process is to find stocks that have low growth expectations relative to an investor's assessment of a company's risk and potential returns. Brings the argument back to risk versus reward versus value versus growth. And there are a couple of steps to make this happen, and I will go through all of them. For an example, I will turn back to VeriSign, the company that I do have a little bit of a bias over, and I'm pretty sure it's going to show. But regardless, this is just an example, and we'll talk deeper about how to apply the thought process in part 2. But for now, let's use VeriSign. Let's just go through the steps. Step 1, decide on which economic benefit to use. So we're using VeriSign, using their trailing 12 months earnings per share, which is $3.15. Step 2, calculate the discount rate or opportunity cost or cost of capital, whatever you call it and however you get to it. Most practitioners and academics probably use CAPM. To save on time and just to give you a different perspective, I will use the average return on equity, since we're looking at an equity valuation. Average return on equity in other telecom industries, and make a company specific adjustment for VeriSign for their extremely high net profit margins and return on capital. So I'll be using a 5% discount rate. Step 3, divide the economic benefit by the discount rate to find the no growth value of the company. Simple enough. $3.15, which is the trailing 12 months earnings per share, divided by 5% or multiplied by 20, and you get $63. That is the no growth price of VeriSign. Number 4, step 4, divide the no growth value of the stock by the company's value to find the percentage of the company's market value based on a no growth scenario. That's definitely a mouthful, but essentially you're just trying to find the percentage of the price that is based off of no growth, the minimal value, as you can say. So you take $63, which is the no growth market price, you divide it by VeriSign's current market price, or price at the time of valuation, which was approximately $77, and what you get is approximately 82% of VeriSign's price is based off of a no growth scenario, which means you subtract the percentage by 1 to find the stock's PVGO percentage, means that approximately 18% of VeriSign's market price is based on future growth. This is where things get interesting. This is where it differs a little bit more from your traditional PVGO approach. So what you can do is reverse engineer the growth rate of the economic benefit based on an investor's time horizon and the no growth price of the company. Based on those implied growth rates, determine if those rates are reasonable. Now, this is how it's done. You take a look at the no growth price. So here we already established is $63. What you also need to take a look at is how long are you looking to invest in this company? Are you somebody who looks to invest over 3 years, 5 years? I'm using 3 and 5 right now. Is it more 7, 10 years maybe? And you essentially try to back in to how long it will the growth rate, it will take the growth from the no growth price to the current price. And that growth rate compounded annually is a indicator to what growth rate is expected of the company. So 82% of the growth, 82% of the price is found in this no growth scenario for VeriSign, which means 8, and we already found that 18% is PVGO percentage. So if you actually compare that, that's $63 today, $14 tomorrow. So if you do that over a 3-year span, you see that the growth rate to get there is approximately 7%. Over a 5-year span to get there, and the same $63 today, $14 today, tomorrow, it's approximately 4%. Now, you can stop right here if you believe that is a reasonable assumption made by the market, and from there you can say that the market kind of have it right. They kind of got it right if you believe that's true. But let's say you don't believe that's true. Let's say you believe that the growth rate should be higher or lower than what the market expects. If you believe the rates are not reasonable, then test various growth rates and scenarios that you believe can happen with the no growth price. So let's say I believe equity research analysts got it right. They're projecting an 8% long-term growth rate for VeriSign. So I plug it in. Use the no growth price, $63, and grow it compounded annually over 8% over 3 and 5 year time horizons. What you get is, over a 3-year span, it's $79. Over a 5-year span, it's $93. And you get PVGO percentages of 21 and 32%. So let's say I believe that's much more reasonable. I believe that if you base the company's price off of this economic benefit, earnings per share is going to grow by this rate over the long term. So let's say I choose 25% as the PVGO percentage, the estimated percentage. It's between 21 and 32%. Based on using earnings per share as the economic benefit, the chosen discount rate, and the estimated PVGO percentage, I estimate the target price for VeriSign to be approximately $84 per share. And here's how. Once again, we have $63 as a no growth value. We estimate PVGO percentage to be 25%, and now the no growth percentage is now 75%. You take the ratio between these two. You take the PVGO percentage and divide it by the no growth percentage, and you get this PVGO to no growth ratio. You multiply this ratio by the no growth value to find the estimated PVGO, the new estimated PVGO that you believe is true. From there, you just add up the PVGO to the no growth value, and you get an estimated market price. Now, as I said before, VeriSign at the time of valuation is approximately $77, which means it's about a 9% difference. Is that high enough to invest? That's your call. I believe that it's not, but it's nice to know. And I also can put into a sensitivity table based off of the discount rate and the PVGO percentage. And as you can see, it can go either way, to be honest. It can either go up and the sky's the limit, or it can come down, not tanking, but there is a little bit of a low that can happen on both sides of the coin. Now, just like every other valuation approach, there are some drawbacks to using the PVGO thought process. Number one, an economic benefit has to be positive. It has to be positive. You can't start off using negative free cash flow number, negative profit margins. So to truly use it, you have to use a positive number. It has to, and there's no way around it. And if you use a positive number that's barely positive, you're going to come up with very high percentages. So you have to just keep moving up on the income statement. The ultimate benefit is free cash flow or earnings per share, but it cannot be used in every situation. So you have to, and I will talk more about this in the second presentation, how you can make those adjustments, but that's one thing to keep in mind. Another key drawback is that the discount rate is the only true way to account for risk. So an investor must have a clear understanding as to how to calculate it, as well as make adjustments for different fundamental factors. Also, an investor must determine if the benefit used will be for all shareholders and debt holders or shareholders only, because this will affect the discount rate. This is another issue. You can't really reflect risk going forward on like in a discounted cash flow scenario. Yeah, it's all packed into one. So if you have uncomfortable feelings about discount rates, this is where this could become an issue. Lastly, the PVGO thought process is best used when an investor has a target time horizon. Based on some initial studies, some preliminary studies, I found that this process is best between a 3 and 7 year time horizon. The process isn't as effective if an investor's time horizon isn't in between these parameters, because if the time horizon is shorter, let's say it's only 1 to 2 years, you will probably deny or reject a lot of stocks. It won't look pretty for a stock if they have any expectations for growth. You're probably just going to invest in companies that have no growth expectations or negative growth expectations. Conversely, if an investment horizon is beyond this range, maybe about 10, 12 years maybe, then you're going to accept a lot of companies that might not be able to pull that off. I mean, you're gonna open the floodgates and just invest in anything because everything's going to look reasonable. Well, everything's not going to look reasonable. So in conclusion, the PVGO thought process can be used as an attempt to quantify the market's growth expectations for a stock. It can be used as an 80-20 approach for idea generation, as well as lead to understanding investor sentiment for a company stock in a short amount of time. That's kind of the goal. You take those main inputs and you put them to work, and you can kind of see what the market's thinking. Most important to me is it changes the discussion from value versus growth to risk versus expected reward, which can lead to finding asymmetric opportunities in stock selection. And that is the main goal. If you look at a company that has an average risk profile and it has above average growth prospects, that's the company you should look into. Conversely, if a company has really low risk and is growing at the same rate at the market, that's another company you should look into. That's the whole purpose and the goal of this thought process. This process is best used for investors that fully understand the major inputs, which is the economic benefit, the discount rate, the PVGO percentage, and have an idea of the time horizon and the growth rate that's expected within that horizon. These are some of the key resources that kind of led me to this theory. As you can see, it's vast, and it's a lot of the things I've been reading. Maybe too much reading, to be honest. But thank you so much for your time, and I will be coming to you shortly with part 2 of this presentation. Goodbye.